last segment, and this is on understanding market movements. Okay. So if you look at this page right here, I'm not interested in trying to explain to you all of the nuances of every change of everything, because quite frankly, I'm not going to be able to do all that. I won't be able to explain all of that, especially in the 40 minutes we have left in this class, okay? However, I want you to just get a concept here about the fact that markets do not just go up, okay? Markets have a volatility to them, and it's by design, all right? It is by design. And you'll never outguess the market makers, and you'll certainly never outguess the algorithms and the computers trading, because they are programmed to trade a certain way to maximize profit. So if you can't beat that, then making minor trading, trying to gain buying and selling on minor changes is a really bad idea. Okay, it's very risky. Overall, remember, market go up. That's, price go up, and so you've got to. The best you can do is understand the concept of how it moves, so you don't get freaked out, weirded out when it drops, and buy high and sell low. Okay. And so you need to understand the principle of what it does. In investing in that way, the best way you can do it, the overall way that beats the market overall, is by putting in investments in what's called dollar cost average investing. Okay, DCA, dollar cost average. And that means that you're not dumping in huge amounts into one thing and then just hoping it goes up from here, because it could go up, it could go down. But rather, you have set amount in your budget that you are going to invest. You've decided what to invest in, and then each Friday when you get paid, or each Monday after you got paid, you put X amount in over time. And sometimes that is going to buy you less amount of your shares, and sometimes it's going to buy you more. It's going to buy less if the price is up. It's going to buy more if the price is down. So just buying on regular intervals over time, you're going to find an average price that's going to be somewhere in that range. Okay, and that's overall statistically shown to be the best way for an average investor to invest, just dollar cost averaging. There is a point at which, if you're investing in markets that are highly volatile, that you might look at certain factors of the fluctuation of the market, okay? And you might invest on down trends. And I personally say it like this: don't invest on big profit days, big green days, right? If that stock or that crypto is got a great big green plus sign in it today, that's not the day to buy, okay? Because here's what you know. This is absolutely the case. Here's the NVIDIA chart. Currently. That's literally what NVIDIA looks like over the last 3 years or 5 years, whatever it is. It's way up there. And here's what people are doing right here, okay? They're going, I got to get into NVIDIA. Look how much it's already gone up. I can't wait to get in it, because it's just going to go up and up and up and up and up and up forever. Euphoria, right? And those people are going to be poor, because they're buying way up here. And I heard yesterday that one of a billionaire investor sold out of NVIDIA this week by the time it hits the news, it probably happened last week, right? And he bought into the Russell 2000. That's interesting. Russell 2000 are all small caps. You invest in the Russell 2000, that's more of a risk on asset, okay? And he's selling out of these trillion-dollar companies and he's buying these little companies. Why? Because he's like, yeah, these companies, they're kind of running out of steam, I think. I don't think they're going to be able to go much higher. And these little companies, I'm going to move my money into them because I think they have a lot of room to grow. Now, if you did that with your, 12 shares of NVIDIA, which would be a great portfolio, okay, it wouldn't make a dent in NVIDIA. But when a billionaire does it,
Yeah.
that's when you start going, Now, does that mean NVIDIA is going to go down? Not necessarily, not right away, maybe. Maybe it stays up there for a little while, letting more people buy in at that high price, but it will go down. There will come, I don't know, how far will it go down? I don't know. It's going to come down somewhere, till the big guys say, yeah, it's worth that again. I'm going to buy it again, okay? And so what happens with little investors is they see these big green candles and they get FOMO, fear of missing out. That's why they buy when the candles are great big green profit candles, okay? Don't buy on green, only buy on red. Even if you're dollar cost averaging, buy on red. Buy when there's blood because the price is lower. It's a discount, okay? But you might see NVIDIA up here and you might go, wow, it came down. Look, it's down a little. It's a red. And he said, buy on red. If it starts falling and you see it fall today, tomorrow, the next day, and it's making big falls, here's another idiom that you should keep in mind. Don't try and catch a falling knife, right? Let it fall until it finally comes to a stable, and then make sure it's not going to fall some more, because this is often what it'll do, right? And then it'll start to recover, okay? And over here is where you're probably more secure after it's recovered past a fall point and back tested it and established it, and now it's going to go up again. That's probably the better place to start buying in an accumulation, okay? So if that makes sense, you don't want to buy when it's green, but you want to make sure that when it's falling, it has some support level that it's not going to drop too far below before you start investing in it, okay? All right, so how does this work? Well, there's a number of theories. The original theory is called Dow theory, and that might sound familiar. Dow theory, it's the Dow market, right? The Dow Jones, right? So Dow was the first one to kind of come up with a theory of the market, and they named the market after him. You can look up Dow theory, and I would look it up. I would read about it. There's two that to me kind of give a really good comprehensive understanding, though, of the market and how it works. One of them is called the Elliott wave. And so this picture here, up top here, is a picture of the Elliott wave. And the Elliott wave postulates that while if you zoom out, it might look like this, right? The Elliott wave says in reality, it looks like this. Right? I mean, it doesn't just go up. It goes up and down and 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 up and down. Okay. So the Elliott wave kind of he did this evaluation. This was a guy that got injured in South America, came back and he was out in California, and he had interest in the stock market, and he sat and literally because of his injury, he couldn't do anything. So he just sat and looked at stock charts, and he figured out, hey, look, there's a pattern in all of these. And he figured this pattern out, and then it got shared with somebody at Wall Street, and they started looking at it, and they're like, wow, it does have a pattern. And so this is kind of a natural pattern in stocks, and it's so accurate that they use big brokerages use this regularly. Okay, so the Elliott wave is this idea that the stock, and you can look at what it is. It has basically 5 stages of an uptrend. Okay, so it'll go up, it comes back down some, and this is the first. So this is 1. Here's 2. That first down, and it's essentially this down. Each of these down is looking for a support level. Okay, and that support level is going to it's creating a base, if you will. Okay, so this would be this. If we drew a line here, that would be called resistance because it stopped there, and this would be support, right? And so it'll go up, it'll find some resistance point, and maybe that point has to do with, typically what that point has to do with is, and then this is, I'm not even going to get into what these are, or and how to explain them, okay? But you can look it up, but it'll have to do with Fibonacci percentages, okay? You look up Fibonacci percentages, but essentially it's a mathematical rule that says something based on where it's at, how high it can go, is a percentage of where it's been and how long it's been there and all this type of stuff. Okay, and this is very consistent. So it'll come up to a Fibonacci resistance point, and it'll fall back down to a support level. Okay. Now then, it might in reality kind of be in here for a little bit, but eventually it's going to come up again. It breaks this resistance, okay? And now it goes back up here, okay? And so it might look like this, and it's going to reach another resistance point, right? And then it's going to backtrace, and that backtrace is going to find another support, okay? Resistance. But ultimately, often what happens in reality is it comes above this resistance a little bit, and then it back tests it and says, is that a good number? And it says, yep. And so then it goes on up to the next resistance, okay? This point is where it turns resistance into a support, meaning in the future, that place, it's going to be hard for it to break below it again, okay? When you're investing, you want to really look for these places to invest. So you're going to dollar cost average, but at the same time, if you really are paying attention to a particular stock, you're not just putting money in wherever willy-nilly, right? You're looking at this and going, okay, its last resistance was right here, and it's down here at this support, and it's verified this is a support place. So I'm going to invest right here at this support level. And now when it goes up here and it comes back, you go, okay, it's hit another resistance. It's holding at this number. I'm going to go ahead and invest a little bit more right here. And it goes on up, and it hits the next one, and it comes back, and it turns that previous resistance into support. Okay, resistance, support, and that's based on, in the Elliott wave principle, that's based on Fibonacci numbers. Okay, I'm not going to explain Fibonacci numbers because that's just way too complicated. But that's the idea. Now, the Elliott wave, he shows here that it has 5 points in an uptrend, 5 points in a bull market. Okay. So it'll go up, it'll come back down. It'll go up, wave number 3, it'll come back down, wave number 4, it goes up to wave number 5. Now, here's a general rule of the Elliott wave. Wave 3 is generally the biggest wave. Right? It's generally the biggest wave. And it's hard to know where these waves start and stop until after they've already happened. Okay, so here's what people will be like, we're in wave number 1. Okay, that might be easier to figure out. But the reality is, because it does this, where does wave number 1 officially end and wave number 2 end and wave number 3 start? That is takes lots and lots of technical analysis and so forth. The more you can zoom out on a chart, the easier it is to see when it happened, but it's very difficult to see in the moment. Okay, so people speculate. People are like, I think we're in wave 1, wave 2, wave 3. Right? Now, there are, if you get the book called The Elliott Wave Principle, and you're so inclined to read it, it's a very boring read. Okay? Just so you know, I've read it. But in The Elliott Wave Principle, after you read it about the third time, you start to understand that this is for me, okay? After a couple times of reading it, I'm like, okay, there are rules for how to determine officially when each wave starts and stops. But I'm going to tell you something, they are really complicated. And as an investor, as a pastor, and not a professional investor, I don't want to spend the amount of time sitting there doing all that analysis, okay? But what I do recognize is that there are certain elements or times where this is going to be turned into resistance. That's all that really matters to me, okay? When it back traces to a resistance point, and generally, as far as investing goes, I'm looking at where did it have last resistance, and I'm going to draw a little box around here, right? And I'm going to say, if it comes back into this area and it retests this resistance and it holds, then this is a good place to start buying. That's simple. It's easy. Does it mean it couldn't go down more? It could go down more. I don't know. I'm not a prognosticator, but what's the likelihood? Well, the likelihood is it's going to follow this type of a pattern. And if it turns this former resistance into support, then that becomes a good buying area, a good place to start DCAing in. Here's the thing, when you say DCA, it may stay in that box for weeks and months, right? So I might be able to buy a little this week, a little next week, a little the week after, and I might be able to keep buying for a few months. I'm investing currently in a project that has been in repeatedly in a box like this for over 800 days. And a lot of people are like, oh, it's never going to go up. But there's a kind of this rule they call it, they say the longer the base, the higher the space, right? Tesla traded at like $2 forever. And everyone's like, it's a dead stock, it's a dead company, it's never going to go. And then all of a sudden it just went boom. And so it was in an accumulation zone, all right? And it built this long base. And what happens is the Fibonacci numbers relate to how long that has been accumulating in that zone. It adjusts how high it can then go based on those ratios. Okay, so this resistance and support is really what Elliott figured out, and he figured out that it tends to run in 5 with basically three pushes and 2 pullbacks to its peak, okay? Then it'll have a larger pullback. And notice that's the rest of this chart. A, B, and C represent a larger pullback. So let's say that you're an investor who you want to hold on as long as possible. You don't want to, you know you're not going to be able to sell at the peak, but you want to kind of get a good vision of where you're at. And you've made good money up through point number 3, and you're like, maybe I should sell here. I'll hold on, but bam, it falls back down to number 4. And then it has a smaller push above that. And you're like, is it going to keep going? Is it not going to keep going? Is this top? I don't know. And then it pulls back. Notice this wave A. This is the first time it has pulled back further than the previous high. You see that? Number 4 is above number 1. See that the low here of number 4 is above the number 1? Okay. And number 5 is above the number 3. These are higher highs and higher lows. Okay. But when you go from 5 to A, you have a lower low. It may be above the last low, but it's also below the high of 3 there. Does that make sense? Now, this is a correction phase, officially, a correction phase. It will come back up some. So I don't want to sell necessarily on A. I'm gonna hold on maybe a little bit. I'm still way up. I'm gonna hold on, and as when it goes back up around where it ended at number 3, that's probably a really good sell point. Notice how B and 3 are pretty close to each other there. That's probably where I really definitely want to sell for my maximum profit. Now, could I sell at number 5? Yeah, if you were, had a crystal ball and you knew everything and what it was going to do, but you don't know. Because here's what can happen. It can hit number 5 and then go into one of these accumulation zones again and then do it all again. Okay, so it may end up looking like this over time, right? As opposed to, seeing these little accumulation zones. So you don't know. And so if you're a long-term investor and you want to avoid big downside, you're going to watch these type of things. Now, how else can you do it? Another way you can do it is by setting stop losses. And basically, wherever the top trailing stop loss, whatever it's reached, if it goes below 20%, 5%, whatever that number is you set, then you sell. That's my rule. I sell it if it hits 25% below its peak, I sell it. That's it. Or 20% below, I sell it. That's all I'm willing to risk. Now, what's the potential that it bottoms right around there or just after there and then goes up to higher numbers? Maybe pretty high. Who knows? There's no way you can know. So you can't focus on the idea of I'm not going to sell because it's going to get back to that high, and you also can't focus on, man, I sold and it kept going higher. You just have to accept that I made money on it. There's another investment coming down the road. Why not chase these big candles? Because there's another investment coming down the road. Look for the next starting point. Don't look for what everyone else is already piling into. If everyone else is already talking about it and invested in it, then you're probably too late. Okay. So just understanding that concept. So there's a couple ways you can use this idea of the Elliott wave. It can be kind of a valuation point. Where are we in the process? And if that next drop comes below a previous high, I better be really cautious here. On the next uptrend, might be a good time for me to get out and take my profits. Okay. Here's the big truth. Profits aren't profits till you cash them out, right? And so it's all just numbers until you cash it out. Back during the 2020 crypto run, or no, I don't know which one it was. There was a guy, they called him Dogecoin millionaire. He bought all this Dogecoin. He was a bumpkin, man. I mean, he was a country bumpkin kind of guy. These guys went and interviewed him. He had bought all this Dogecoin real cheap, and it went way up. This would have been during the last cycle, during 21. Dogecoin was worth $3 million. He lived in a mobile home. This Dogecoin was worth $3 million. And these guys went and they interviewed him, and they're like, are you going to sell enough to get out and, do this and this? And he's like, nope, holding on to it, diamond hands to the moon, right? And it was at it went up to like 70 cents a Dogecoin. And then it fell like 99%, okay? And he lost down to, still a decent number, but he's going to hold it forever. Okay, well, that's really noble of you, all right? But the purpose of investing is making money, not just having, the investment. So if you're at a point where you start to look and go, this tech has some technical downside that may be coming, it may go down here to the C, okay? It might be time to take some profits off the table. Maybe I don't sell it all, but I take some profits off of the table and I put it aside and I wait. Maybe it's going to come around where there's another accumulation pattern and I can buy back in and ride it up because I really like this one. But right now it's risk off. I'm going to take risk off the table and I'm going to wait or find a new investment that I think I've seen in the accumulation so that I can ride it up. Yes.
If you have crypto on a wallet and you have a certain amount that you're looking to take profit at, would you recommend putting that on an exchange at the beginning just to have, so when that time comes?
No, I'm not going to. I mean, you can transfer it at any time. Yeah. So, and most of the time you can actually sell on the wallet anyway if you want. Yeah. So, all right. All right. So that's the Elliott wave. We have like 15 minutes left. Okay. So the Wyckoff principle, there's the next picture down. Wyckoff says these Elliott waves work, but here's the thing, there's more detail that you can look at. And there's a place where there's an accumulation area where the value is below what it ought to be. It's oversold, okay? Too many people got fearful. They sold too much of it. It's oversold. And that is where you want to accumulate. But then when it goes up, people get too greedy and too many people buy into it and they overbuy it, right? Oversold, overbought. Now, there's a way to track this. It's called, it's a thing called RSI. An RSI, brain. I don't remember what RSI. I don't remember what it's called. RSI wouldn't either. But basically, it charts the stock based on this concept. Okay, and it will chart it like this, and it'll say at 30% it's oversold, and at 70% it's overbought. And you kind of are looking to the idea of, hey, you might not want to be buying something if it's in the overbought territory. You might want to wait till it's in the oversold territory, because it will fluctuate. It might not fluctuate as fast as you might. I gotta be in that deal. Well, you need to learn to moderate your feelings like that, and be a wise investor and just wait, or find something else that is in the oversold area and invest there. Invest when no one else is interested, and sell when everyone else is interested. Okay. So this is the concept of the Wyckoff accumulation distribution. There's a time when too many people get fearful and sell too much. That's when you want to buy. And there's a time when too many people are greedy and they buy too much. That's when you want to sell. Okay. So look at the charts on the next page. Accumulation is the top one. So if you look from the left-hand side, I'm sorry, you notice it's fallen, and all of these numbers, if you just look up in this chart, it says stockcharts.com and wyckoffanalytics.com. Go there and you can find explanations for all this. I'm not going to give you all the explanations. We have 10 minutes left in class. Okay. So go there and you can find what all of these PS, SC, AR, ST, all of that means. Here's the thing. It is not necessary that you are a stock analyst extraordinaire in this, or a chart analyst extraordinaire, to be able to use this. You don't have to know what all of these things mean to be able to look at the big picture and see stuff, okay? You just have to zoom out of the chart. If you're on the 1 minute chart, you're gonna get a really different picture than if you're on the 10-year chart or the 3-year chart, okay? And so what you wanna do is zoom out. And this is a phrase that's used in technical analysis. When in doubt, zoom out, okay? And get a bigger picture and see what the big picture looks like. Now, here's what most people think about the crypto market, just so that you get an idea where we're at right now in the crypto market. Most people think we're right here in phase D, okay? Probably at this, from SOS to the BU/LPS area. Okay. And it's just getting ready for phase E, which is the breakout phase that starts in the second picture down and goes all the way up like this. Okay. It could be that we're at LPS. That's possible, but most people think that in the Bitcoin market, at least, we're at this BU LPS area range. Okay. Now, in some other cryptos, they haven't now because the way the crypto market works is that it rolls. It's like Bitcoin goes first, and then Ethereum. Okay, and so Bitcoin skyrockets, and then it rolls over into Ethereum. It skyrockets, and then it rolls over into large caps. They skyrocket, and then that rolls over into mid caps. They skyrocket, that rolls over into small caps, and so forth. Okay, so basically, what's always happened in the crypto market is people take profits from here, roll them in here, and then in here, and then in here, and then in here, and they just keep rolling them down into the smaller ones. So the smaller the market cap, the later in the cycle that it takes off. So not every crypto is in the same phase right here, and not every stock is in the same phase. So you got to look at each one individually to kind of get a big idea and on where it's at. But essentially, you know, it's somewhere in this range that we've seen it come up. It went way down, it's come up, it went back down, it's come up, and it's kind of nearing that point where historically it has taken off. It's generally for the crypto market anywhere from 3 to 6 months after the halving of Bitcoin, and so that happened in April, and so we're getting closer and closer to that, and it's happened as early as 60 days before, and it's happened as late as 6 months, but average is around the 3-month time frame, about 90-day time frame. But never before has there been ETFs and all that type of stuff, so no one is really sure exactly when it's going to happen this time, but that's the idea. It's in here somewhere. The Wyckoff picture is really, it's not about being able to necessarily identify exactly where we are per se, as much as it is to be able to identify the zone we're in. Okay. In other words, how do I know if this is going up, and it's really been going up a lot? How do I know when we're in that distribution zone, time where I should be selling somewhere in this range, right? I can see this pattern playing out, and there are rules to how this pattern plays out, but I can see this pattern playing out, and I can go, oh, that's a standard Wyckoff distribution model. And big companies and computers are selling off, and they're trying to milk it. And in other words, they don't just get to the peak and just immediately drop. What they want to do is they want to milk as many little people into their distribution. So they come down a bit, they sell off, and they come down, but they're not going to sell all of it off. They want people to go, oh, look, it's a good time to get in, and it gets back up, and they start selling it off again, and they do that several times. That's what this shows. You see that? They sell off some, they buy it, the people buy back in, they sell off a little more, people buy back in, they sell off. They may do this 3, 4, 5 times as it goes along, and that's these billion-dollar companies taking their profits out, just a little each of those peaks. Okay, and that's what's causing the market to go down, and then they're hoping for all of us suckers, otherwise known as exit liquidity, to buy in at these high prices, and then they're gonna over here. They're finally like, all right, we've got all of our product that we're gonna milk out. Now let's sell the rest, let it fall down until it gets back down into what we consider an accumulation zone. Then they start accumulating, and this is the pattern they take before they say, okay, we've got all we want. You generally don't realize that you might think these prices are so low, no one's buying them. No, they just know how to buy large amounts in small increments so as not to raise the price while they're accumulating their position. And then they know how to sell in such a way as to be able to make make max profit on the whole position, because you're not talking about people that own 100 shares. You're talking about people that own 10,000, 100,000, a million shares of something. You can't just sell 1 million on the open market. There might not be enough demand. So you've got to sell only enough to drop the price a little bit. People think it's a good deal to buy back in, and then you sell a little more and you sell a little more on each peak. Okay. And so this picture of the Wyckoff accumulation and distribution helps you see the psychology of what the big people are actually doing. Okay. And that's really why I wanted you to get that idea there. Okay. So there's all these little abbreviations mean stuff. You can look up Wyckoff. You can watch videos on it. There's videos that you can go on YouTube. Wyckoff explanation, Elliott wave explanation, and you can watch videos and get more information on it. I just wanted to introduce the concept to you because essentially the market runs on these principles, okay? And it runs on these patterns. And if you understand that, it is not accidental. It's not an accident when they're going up or going down. It's someone pulling the levers of buying and selling and or holding and not selling while demand is going up to drive the price up higher, okay? That is what's going on. And these principles essentially explain the pattern that is used, okay? Oddly, the pattern has been out there since the 1930s, and people know, but they know the average person doesn't know and won't know because they won't do the research. They just get on YouTube or social media and they hear someone saying, oh my goodness, this stock is going to go to the moon. And they watch Jim Cramer, who's like maybe the worst person to watch in all of stocks. I'm being literally serious there because Jim Cramer is a master manipulator, deceiver, and he says, I'm trying not to, that was probably liable, wasn't it? Good thing this is there was such a thing as the inverse Cramer ETF for a while, where whatever he said, they did the opposite, all right? Because there were people publishing that you could make money just doing the opposite of whatever Jim Cramer says. And so it's kind of a big spoofy thing, but it's true. I mean, he's wrong a lot. And, when Bitcoin was down at, 30,000, he's like, sell it. It's garbage. Don't buy it. It's going to zero. And then when it hit 60,000, he's like, buy. You got to get into Bitcoin right now. And then it drops back down to 50. And he's like, sell it. It's junk. Don't buy it. Why are you in this to start with? And so this is the type of stupidity that he does. Anyway, so that's my point is if you watch these folks, you're going to find all kinds of weird information. Study the guys, Dow and Elliott and Wyckoff. These guys establish principles that they work. They really work. And they're not currently trying to market any particular products, okay? They're dead. And so that's why it's good to read after them, all right? Because they're not trying to sell you anything. They tried to explain something. And so if you want to learn about it, study that. All right, any questions real quick? Yeah.
Do you suggest a trailing stop loss then whenever you invest? Or?
As a general rule, it's probably a good idea. I don't necessarily suggest it. I think you got to decide what your goal is. And if your goal is that you're going to hold, you think that this asset class as a whole, this stock as a whole, is going to have lots of ups and downs, but eventually it's going to end up over here, and then a trailing stop loss may only get you out of it before it goes to the higher point. I mean, it's just how much risk tolerance you have, and that's why I said before, if you have high risk tolerance because you're young or whatever. You can stay in something longer than other people might. But if you're getting to that point where you're like, man, I can't afford to have that much risk on the table, then yeah, maybe get out of it and put it into something safer at that point. A good rule of thumb is if you can't sleep at night because of the risk, get out of it. Peace above profit. Okay, so that's a way to look at it. So, right? Peaceful poor man. Hey, better is peace with a little. And the Bible says that. Better is peace with a little than trouble and great great storehouses, right? So, you know, yes,
Not interrupt, I just had a question, so if you want.
go ahead.
Okay. On those crypto utility tokens and so forth, those are purchased the same way with a stock, I mean, on an exchange or whatever?
They would be purchased on the crypto exchanges, yes, not on the stock exchange.
Okay, so in other words, say I was using something like Fidelity
You could purchase only ETFs,
ETF.
like the Bitcoin or Ethereum ETF, but you can't purchase like XRP, XDC, or those utility tokens. You can't purchase the tokens directly, only exchange traded funds that might hold tokens.
That's that app,
Coinbase,
Gecko or whatever. CoinGecko.
you can't buy through CoinGecko, but you can research on it. Coinbase, yeah, just for research. Coinbase, Crypto.com, Uphold, those are places you can buy.
Okay, thank you.
Other questions? I hope that this has been helpful and informative and that you aren't too confused right now. I knew today would be the most mind-numbing part because I'm trying to explain things that most people have never even, I mean, you've heard of stocks, but your understanding of stocks maybe was already greater than your understanding of options or crypto. And so, I mean, introducing a lot of new concepts and thoughts. So I knew it was going to be, but hopefully, overall, the study here has been helpful to you. You'll take the biblical principles, apply them to your budget first, and then to your investments, and that God will bless you because you're diligent about your finances. Okay, all right, we're dismissed.